Okay, fun seekers, do we have a treat in store for you? We're going to learn all about how mutual funds charge their investors. Fees, and more fees. So I want you to get a sheet of paper out and write down A, B, C, and F in big letters across the top, because we've got to learn about all these different share classes. Let's get started. Slide 21. All mutual funds have what are called annual operating expenses. Why? Because they got to run the fund. They got to pay for the lights and the rent and all the websites and the janitors and all the people who actually make the decisions and run the fund. And so those are called annual operating expenses. And on slide 21, we see the three major types. The management fees, which are charged yearly based on a percentage of the fund's assets. This often is the largest, but not always, the largest fee that is tacked on. It's paid to the folks in the top hats. Remember them from our last presentation? The portfolio managers, the research analysts who help either make the investment decisions or help make the investment decisions. Then there are 12B1 fees. What a dumb name, 12B1. Well, that's the section of the Investment Company Act that they're talking about. And this is a fee that is charged against the fund to defray advertising, servicing, and distribution costs of the fund. And it can be up to 1% per year. So you see, what the mutual fund is being asked to do is tell you how much they're paying for advertising and servicing and distributing the fund. Does Coca-Cola tell you how much they're charging you every glass of Coke you drink for advertising? Does it show up on the sticker for the new car you're looking at, how much they spent on advertising? No, but mutual funds have to do that. Indeed. And then the last one is the all other expense category, the accounting, the rent, all that other stuff that they have to pay for. Now I have a line here between the first three and this fourth one, because the fourth one is a trustee fee that goes to a separate entity if you have a IRA or if you have a Roth IRA, and that is typically $10, but I've seen it up with $10, $30, $35. And that's because when you have a retirement account, technically the money cannot be in your name. It has to be in the name of a third-party trustee that holds on to the funds and makes sure that you do what you're supposed to do and your company does what they're supposed to do, so the IRS will not tax you. And that's, the old way was you actually wrote a check for it, but not anymore. They just take it out of your account. And so we'll not discuss that too much. Slide 22. Trading costs. Well, this is the one fee that is not disclosed in the annual prospectus. So how does an investor know how much the trading costs are? Well, you can actually ask the mutual fund and they will tell you. Or it is easier to look at the annual turnover, because the more the fund turns over the portfolio, the more costs they're going to incur from trading. It's measured in terms of the amount that is turned over, that is bought and sold within the fund every year. So if you have 100% turnover, that means within 1 year they will have gone through all the securities, whether stocks or bonds or short-term investments, in the mutual fund. 50%, that means it'll take 2 years to go through it. 25%, 4 years. And the higher the turnover, the higher the trading cost. Plus, the higher the turnover, the more they're not really investing, the more they're trading their securities. In my humble opinion, And so I look for a stock mutual fund that has a turnover about 20-25%, which means they hold on to the stock for about 4 or 5 years, maybe 3 years, 33% or so. And why is that? Well, we'll learn more about that when we get into the chapters on stocks, chapters 5 and specifically chapter 6. And we'll see that there's a very important characteristic about stocks that 3, 4, 5 years are about as far as we can predict into the future, and even that is very, very tenuous. Now, there's a caveat that goes with this. If it's a money market mutual fund, they're turning over the thing every 30 days or 60 days or 90 days because their investments only last that long, right? So you have to be careful. But when you're looking at a stock mutual fund, you want to see about 25%, 30%. Bonds, similarly, even less, in my humble opinion. Yeah, and one of the things I'm going to ask you to look for is the turnover rate for the mutual funds that you research. Now, what about loads? Slide 23. The eternal debate, the endless debate. Should you purchase a no-load fund or a load fund? Oh, you should always buy a no-load fund. Yeah, bypass the middleman. Don't go with a broker. Don't go with a financial advisor. Well, folks, in the investment world, there's no such thing as always. Well, maybe there's a few, but everyone's different. And if you believe you need the help of a financial representative, it turns out that load funds, over the long term, are the cheapest alternative. And we're going to see that as we go through this presentation. But if you believe that you can pick your own funds, do your own research, then certainly a no-load fund is a good choice because you don't have to pay that upfront fee. However, be careful. You must look at the annual operating expenses. So it's not as straightforward as some people make it out to be, in my humble opinion. And of course, I'm right. Slide 24. Let's take a look at the different load funds. Traditionally, the very first funds were all front-end load. And what you will see when you look at the company's websites, their prospectuses, their reports, you will see them normally called Class A. A couple of them called Class 1, but it's called Class A. There's a commission that is paid up front when the shares are purchased, and they normally have lower annual operating expenses compared to their other alternatives. Where does that commission go? Well, some of it goes to the mutual fund company, the distributors, that part of the mutual fund company called the distributors. The other part of it, the bigger part of it, goes to the brokerage firm, of which the broker is the employee, and then they share it with the broker in a certain percentage. And so that's how we get the name, commission-based brokers. Brokers work traditionally on commissions. You can, of course, buy the Class B shares. And if you remember back-end B, these things have become less and less popular. They have a commission that is paid when the shares are redeemed. And so people say, well, what's the difference? Come on, give me a break. You're going to hit me up front or hit me in the back. And they say, no, relax. This back-end load is actually what we call a contingent deferred sales charge. Isn't that a great name? I love contingent. Say it. You can feel your voice, your throat vibrate when you say contingent deferred sales charge. And what happens is it starts off at 4 or 5% and then goes 3, 2, 1, and then after 3, 4, 5, 6 years, it's gone. So you see, that's a way of enticing you to hold on to your shares for the long term, because mutual funds, by definition, are a long-term investment. But what happens is they tack on some extra fees in the annual operating expense category of the 12B1 fees. So you wind up paying a higher annual operating expense in general, And then eventually, after 6, 7, 8 years, sometimes longer, the Class B shares will revert to the A shares, which have a lower annual operating expense. Are you confused yet? Good. We've done our job in the industry, and we will continue to try to confuse you. It will make more sense when we actually start looking at some examples, okay? So make sure you got that piece of paper and you've written A, front-end load, B, back-end load, and then we'll continue by looking at Class C shares, which were called broker no-load funds traditionally, but now they're not allowed to be called broker no-load funds. They are load funds, or so says the Securities and Exchange Commission. There's no upfront fee. There's no back-end fee. Well, they'll usually charge you 1% if you take the money out within 1 year, but you're not going to do that because it's a long-term investment, right, Mr. and Mrs. John Q, public investor? Yes. However, as we saw with the Class B shares, the Class C shares have higher annual operating expenses in perpetuity. Don't you just love that word, perpetuity? You get this spit on your friends. No, or for a long time, 10 years or so. There's those pesky 12B1 fees again. Hence, the Class C shares with no front-end load, no back-end load can wind up costing you more than the Class A or Class B shares. And the FCC, the Securities and Exchange Commission, was not too happy about brokers calling these no-load funds. They said, look, even though you're not charging an upfront fee, even though you're not charging a back-end fee, if you're charging a 12B1 fee that is greater than 0.25%, then you must call that a load fund. The load is being amortized. You know what that word means? It's a fancy way of saying stretched out. The load is being stretched out over 10 years or so. So now Class C shares are not allowed to be called broker no-load funds, even though many people, not too many people, still do. They got another trick up their sleeve, as we'll see. So now let's take a look at the no-load funds. Slide 26. The no-load funds are many. There are other types of shares, but we're going to look at the two major shares. And the first one are the advisor no-load funds. See, these have replaced the broker no-load funds because they really are no-load. There's no upfront fee. There's no back-end fee. There's lower annual operating expenses. So how does the broker make any money? What they do is they put it in what's called a wrap account or a management account or a wealth management account. And then they tack an extra 1 or 2% on to manage the account. And these are very popular, folks. I got to tell you, I don't have any clients who do this. I wouldn't go out and buy this. It's not in your best interest. Because what's happening is you are going to wind up paying far more over the long term. But it's hard to fight the entire industry. And I have seen people just completely gullible, just completely being told, oh, don't worry about these fees. Obviously, we're not your brokers anymore. Oh, no. We're your wealth managers. And I remember one guy, after I asked him, I forget exactly what I asked him, but he said, you send them a bottle of wine on their birthday, something for Christmas, take them to the golf course, they're happy. And I thought, but are you explaining to them how they're being charged? And then I put quotes around true no-load funds because there's no legal name, true no-load funds, but that's the term you will read or hear about in the financial press. These are mutual fund companies that deal directly with the public. They may not have a 12B1 fee greater than 0.25% per the Securities and Exchange Commission. Bypass the middleman. Who needs a financial advisor? Just tune into our show or listen to us or buy my book. I'll tell you which mutual funds to invest in. But be careful. Again, a no-load fund is not necessarily going to be cheaper in the long term if the annual operating expenses are higher than the load fund. This is one of the things they did to us at Southwestern Community College with our 403B 457 plan. They came in and said, oh, we're not charging you any upfront fees, not like some of those brokers who are out on the outside. No, we're just hitting you with an extra 0.7% in perpetuity forever. That was nationwide, by the way, folks. Nationwide insurance on your backside. And I would tell anybody at Southwestern who was, unfortunate enough to be within my earshot about why they're screwing us, and they'd kind of shake their heads and go, oh. And in fact, one of the folks who worked in the benefits office I kept explaining it to them, and she finally took my class and said, you know what? They really are screwing us. And finally, good news, they've been replaced by a company that's the fees are much less. It's still a little shaky, but still they're a lot better than they used to be. Okay, so are you thoroughly confused yet? I hope not, but maybe you are because it's a confusing subject. Let's now take a look at a real mutual fund and some real fees. And this is called the AB Large Cap Growth Fund. Now, is that a stupid name or what? It started out at Alliance, and then Alliance merged with Bernstein. I forget the first name. I forget Sanford Bernstein or whatever. Another venerable company. And then they called it Alliance Bernstein, which is kind of a bit of a mouthful. So now they call themselves AB, which I don't know, folks. I'm not a marketing person, but I don't know if it's such a great name. But anyway, that's their name, AB Large Cap Growth Fund. It's actually a very good fund. It's been around for a while. And what they do is they charge you 4.25% on any money that you put in for your Class A shares. So you put in $100, that's $42. No, $4.25. I'm sorry. You put in $1,000, that's $42.50. You put in $10,000, that's $425. You put in $100. Well, no, wait a minute. What happens is as the amount that you invest or as your account gets larger, that sales charge starts to go down. And we'll see the schedule later on in the presentation. And that's why you see it say maximum sales charge. But most of us are going to put $50 a month away, so we're looking at $2.12, right? The management fees are 0.75%. Now, what does that mean? People don't feel comfortable. Come on, stay there, mouse. That means that for every $100 you have in the account, they're charging you 75 cents. And they do that for as long as you have money in the account. That's the fee that goes to the money managers, the people in the top hats, right? There's the 12B1 fee. 0.25% goes to distribution and or servicing marketing of the funds. Just as we said, other companies, other industries don't have to show you. The mutual funds do. And other expenses, 21 cents for every $100. So we're looking at $1.21, 1.21%. $1.21 for every $100 you have in the account. And you go to your broker and you say, well, Ms. Broker or Mr. Broker, I don't want to pay that upfront fee. And what do they say? No problem. There's always no problem. I don't know if you noticed that yet, but you will when you talk to these people. No problem. It's not just financial. It's real estate. It's car companies, whatever. No problem. Well, for you, we have the back end fee, the back end charge, the Class B shares. No upfront fee, a maximum contingent deferred sales charge of 4%. And you say, well, Ms. Broker, what difference does it make if you hit me in the front or hit me in the back? Oh, relax. That's a contingent deferred sales charge. What does that mean? It means it goes down over time. 4, 3, 2, 1, and after 4 years, or 5 years, in the 5th year, you don't pay any back-end charge. And you're going to hold on to this for the long term, right? You're long-term investors, and mutual funds are long-term. Oh, yes, Ms. Broker, yes, you're absolutely right. The management fees are the same, 75 cents, but what happened? Right. The 12B1 fees have been increased to $1. And see, that's how they're paying the brokers, right? Okay. They've snuck in that commission into the 12B1 fees. And that's why the Securities and Exchange Commission says you can't call it a no-load fund if the 12B1 fees are greater than 0.25%. The other expenses, excuse me, 23 cents. And so now we're looking at $1.98 for every $200 you have in the account. Which, now we're getting into what the banks and the life insurance companies charge. 1% or so, that's typical for a mutual fund, but 2%, it's still not as much as banks and life insurance companies charge you. But do banks and life insurance companies have to show you what they're charging you? No, they don't. And so do they? No, they don't. If you ask them, they'll look at you funny and say, oh, well, I don't know that. Yeah, because they don't want you to know. All right, so you go and you say, well, Ms. Broker, I don't know. Maybe I'm going to take this money out within a couple years. So I don't think I really want that upfront, back-end fee. And she says, no problem. Have a seat. For you, we have the Class C shares. No upfront fee. A 1% fee if you take the money out within 1 year. But you're not going to do that because it's a long-term, right? Okay. So you have the 0.75%. That didn't change. The 75 cents for the managers. There's the 12B1 fee. 20% of $1 of 1%. 0.20%, 20 cents for every $100. And the Class C shares wind up costing a little bit less than the Class B shares. Yeah. So you go to your broker and you say, Ms. Broker, I don't want the upfront fee. I don't want the back-end fee. I want low annual operating expenses. And she says, have you figured out what she says? No problem. For you, we have the advisor class. We're not your brokers. No, we're your wealth managers. No upfront fee. No back-end fee. 75 cents for every $100 in the account. Well, that's how the mutual fund managers get paid. And look, no 12B1 fee. Other expenses, 0.2%. So now we're looking at 95 cents, 0.95% for every $100 that is in the account. You get lower annual operating expenses in perpetuity. What was that, Ms. Broker? We charge you an extra 1 or 2% wealth management fee every year. They tack on upwards of 2% a year. And I have explained this to people. And after I've explained this to people, sometimes they shake their heads and go, well, that's not right. I shouldn't do that. Or they say, well, I've already gone with this person and they're so nice to me. Or maybe it's somebody from church. One individual, it was their church group. And you got to be careful, folks. When anybody starts throwing Christianity or religion into finance, you just look at them straight in the eye and say, wait a minute. Render under Caesar that which is Caesar. Render under God that which is God. This is Caesar, folks. This is all Caesar. This isn't, anyway, I'll leave this for the theology class. So do you understand? Sure. You don't pay upfront fees. You don't pay back-end fees. The mutual fund doesn't charge you annual operating fees that are very high. But the brokerage firm does. And I'll never forget one guy in my one class, face-to-face class, who showed me his family. His family is very well off. And it was a substantial sum of money. A big account. And they were getting charged 1% a year, which in this case was about $10,000 a month. And this was a big statement. And the very last page, it had that about $10,000 fee. And I said, do you understand that they're charging you this every month? He goes, no. I said, didn't your family understand that? No. I don't know what he ever did with it, but this is what you're up against, folks. And reputable brokers will make sure you understand this. But most won't. Most won't. Well, I might just say most. Many won't. And they'll just say, it's just customary. That doesn't mean it's good. It's customary. And so I have the privilege of being able to, snipe at the industry from inside my cushy little professor's job. So they might turn around and say, well, what does he know? But I'm also a broker, and I don't sell these things, the Class F shares, Class I shares, investment advisor, financial advisor shares. I wouldn't buy them, and so I would not sell them to my clients. And that's me. Everybody's different. Okay, so let's take a look at a different fund. Make sure you've internalized that, because now we're going to throw you a couple of curveballs. No, not really, not yet, a little bit later. This is the Franklin Growth Opportunities Fund. Another pretty decent fund. Franklin Templeton, a very venerable company. I like that word, venerable company. Ooh, 5.75%. So their maximum sales charge is higher than the previous one. But notice their management fees are a little bit less. The distribution fees, the other expenses, so they're actually charging a little bit less than the previous fund. Not much less, but still. They are charging you a higher upfront fee, but lower annual operating expenses. Plus, their schedule for lowering that maximum sales charge is a little bit more aggressive than is Alliance's. So it evens out. Now notice they have no Class B shares. They didn't bite the Class B share apple. They stayed away from those. But they do have the Class C shares, which have no upfront fee, the 1% charge if you take the money within a year, which you shouldn't do, folks. If you put money into a mutual fund, you should leave it there for, especially if it's a stock mutual fund, you leave it there for years, because that's their long-term investments. There's the 65 cents management fee. There's the dollar, right? There's the distribution and or service fees, the 12B1 fees, 23 cents and $1.88. A little bit less than the one we looked at before. Not much, but still a little bit less. And then their advisor class, again, no upfront fee, no back-end fee. 65 cents for the management fee. 23 cents for the other expenses, so 88 cents. But remember, right, they tack on the 1 or 2. I've seen it less than 1%. Not much, but I've seen it less than 1%. Never seen it more than 2%. A little bit of story. It goes back to the religion. A client who was dealing with the people at her church and was saying that they were going to charge her 2%. And I explained what's going on. Do you understand? They're going to charge you 2% every year on top of whatever the mutual funds charge. And she went back to them and explained that, and boom, they just dropped it from 2% and 1% in one sentence. They didn't argue. They didn't try to say, well, no, we deserve this. They just said, no, we'll charge you 1%. That's how profitable those fees are, because the broker's not doing much. I mean, they're mad. They're looking over the mutual fund, but that's what a broker's supposed to do. Your broker is supposed to do that after they sell you the shares and get their upfront fee. They're supposed to continue to do that anyway. So, but how can you argue with somebody at your church, right? Obviously. So, slide number 29. Here's another famous, now infamous, no load, now load mutual fund. This fund, we'll come back to, is called the Legg Mason Value Trust. Well, not anymore. That's when it became famous. It's now called the Clearbridge Value Trust. What's going on here? Well, for many years they only had the Class C shares, which were called primary shares. They had the financial investment advisor shares, and they had the institutional shares. They recently added the Class A shares. I'm not sure why, but they did. So let's look at the Class A shares. It turns out that their upfront fee is like the previous one, 5.75%. Their management fees are 68 cents. There's the 12B1 fee, 25 cents, 9 cents, so $1.02, which is lower than the first two, isn't it? Now, the primary shares, which is their bread and butter, and the ones that they've been around the longest, and they call them the Class C shares now, no upfront fee, 95 cents, 0.95% if you take the money out within 1 year, but you're not going to do that. 68 cents to the management company, almost a buck. Remember, the other one went up to $1, 0.95%, and then 12 cents for the other expenses, so $1.75. Which is it's pretty typical, isn't it, for the Class C shares? Right. The financial investment advisor shares have no upfront fee, no back-end fee. The 68 cents, they do include the distribution and or service fees, and 18 cents. So we're looking at $1.11 plus a 1 or 2%, depending on your investment advisor's. It convinces you how much they should charge you. Excuse me. Okay. And now institutional. Wait a minute. Do you have to be institutionalized to get these? No upfront fee, no back-end fee. 68 cents, the same for all the others. No 12B1 fee, 12 cents, so 80 cents to the dollar. How do you get the institutional? Well, we'll talk about that in a bit. But the first three, even though this one started out as a no-load fund, but because of the Securities and Exchange Commission saying you can't call it a no-load fund if the 12B1 fees are greater than 0.25%. These are all examples of load funds. Now for something completely different. We're looking at a very famous fund here, folks. The Vanguard 500 Index Fund. And this is an index fund, and we'll discuss these in more detail as we go along. But remember the people in the top hats? This fund does not have anybody in the top hats. It does no research. They look at a stock index, and this stock index is called the Standard & Poor's 500. We will discuss it in detail in Chapter 5. But for now, all you have to know is that it's the 500 largest companies based in the United States, more or less. And so you or I could run this fund. We could put the top hat on, even though we don't need it. And all you do is you go look at the list of 500 companies, and if they're on the list, you buy them, and if they're not on the list, you don't buy them. It's that simple. The term for this is called passive management. As we said, we'll discuss this in detail in more later on. But index funds are usually true no-load funds. There's usually never an upfront fee, a back-end fee. And usually, but be careful, not always have very low fees. So look, no upfront fee, no back-end fee, 14 cents for the management fee. That's a lot lower than any of the others we've looked at. It better be, because they're not doing anything. So there's nothing for them. They don't go knock on Ford's door or Toyota or GM's door and ask them how they're doing and look at their competitors and look at their suppliers and their customers and their vendors, the people who they they don't do that. They don't do that because they don't have to. In fact, they're not allowed to. If the stock is not in the Standard & Poor's 500 index, then they can't buy it. If it is, they have to buy it. It's that simple. The 12B1 fees are limited to a $20 annual fee if your account is less than $10,000, which means, they're trying to get you to put money in there. But if you sign up for electronic delivery, then they waive that fee. And then 2 cents for other expenses. So 16 cents. Pretty darn cool, isn't it? Don't you think? Yeah, 16 cents. Why? Because you're not paying for the management. Exactly. Now, as I said, you have to be careful. Some 403bs, 401ks, they will sneak in these index funds with large annual operating expenses. Who would do that to their employees? Well, it turns out a lot of companies, and as I said, many of them don't even realize it's being done. It's the insurance companies and the brokerage firms and sometimes the mutual fund company, but very rarely. It's mostly insurance companies that do it. Nationwide, I will refer to again. And go ahead, guys. Sue me. I wish you would sue me. But they're no longer our third-party administrator who is sneaking their own index funds into the mix. They just changed it, and I have to take a good look at it. So I'll report back. But yeah, so be careful. Look in your 401k. Look at the index funds and see if they've snuck in some index funds with higher annual operating expenses than, say, Vanguard or Fidelity. Speaking of Fidelity, let's take a look at slide 31. You see, Fidelity used to be the #1 mutual fund company for decades. Not anymore. Right. Vanguard pioneered the low-fee index fund world and was able to overtake Fidelity as the #1 mutual fund company. So you can imagine, what was said in the boardroom at Fidelity. So they responded, eliminating their sales load, creating their own index funds, lowering their fees below Vanguard. So their management fee is 0.015%, 0.075% for other expenses. There's a low balance annual fee like Vanguard has, which you can get rid of by just enrolling in automatic purchases. So they've gone from whatever Vanguard was 15%? No, 17%? Yeah. Down to 16%. I'm sorry, 0.16%. Down to 0.09%. It's like limbo. How low can you go? All right, Vanguard, take that. We'll out Vanguard. We'll come out with, and they've been very popular. Their Fidelity index funds. They had a dumb name for them. They finally got rid of. They called them the Spartan funds. Spartans, and people don't really understand. They think of the Greeks and the Trojans and the USC and all that stuff and Troy, but no, the Spartans were very abstemious. You like that word, abstemious? It means sparse. Where do you get the name Spartan? It means not luxurious, cheap. I guess I shouldn't use the word thrifty. How's that better word? Abstemious, thrifty. So you see, there's a lot of competition and a lot to know about these fees. Slide 32. Along with the annual operating expenses, all prospectuses must show you hypothetical $10,000 investments with a hypothetical, meaning not real, 5% return, because you don't know what the return's going to be. It's the future. So here's that AB, Alliance Large Cap Growth Fund, starting off with year #1. And we noticed that the A shares cost us the most. Well, because we had to pay the upfront fee of, $423. But then as the years go by, the B and the C shares wind up catching up and costing us far more. Why? Because of the annual operating expenses being higher. So you see where we get the phrase, no load funds can wind up costing you more than load funds? You must look at the annual operating expense. And this assumes that you're going to be in it for the long term. Yeah. If you're in it for the short term, then it doesn't really matter, but then you really shouldn't be playing around with mutual funds. Now, the advisor class looks like the best deal, doesn't it? Right. This does not include the advisor's annual fee. Adding the advisor's typical fee of 1 to 2% per year would easily add an additional $1,200 to $2,400 to the total cost. So over the long term, which is the best deal, dear students? If you believe you need the help of a financial advisor, then the Class A shares typically are the best deal over time. But because of that upfront fee, financial advisors sometimes have a hard sell to get people to pay that upfront fee, so they will show you their advisor no-load funds, their Class F shares, their Class I shares, and people will go, oh, okay, yeah, I'll go with that 2% per year. Okay, off your soapbox, Bayano. Let's continue. Here's the Legg Mason Value Trust, which is really now called the Clearwater Value Trust. And we see the A shares again being more than the B and the C shares in year #1. But as the years go by, once again, the C shares wind up, they don't have any B shares, wind up being more expensive than the A shares. The financial intermediary class shares don't include the tacked on advisor's fees. So again, you have to add $1,200, $2,400 to these amounts. And then the institutional class certainly is the best deal, but how do you get? Well, you have to be a large pension fund, a university endowment. You have to be a tax-exempt charity, and do you have at least $1 million to invest? No, get out of here. So you and I are not going to get the institutional class shares. Does that make sense? I mean, it's pretty straightforward. Okay, now here's the Vanguard Index 500 fund again. And what we see is that the fees for passively managed index funds will almost always be less than actively managed funds, with the caveat that you better be careful because some of these brokers are going to sneak into your 401k high fee index funds because they can, and they're pure profit for them without having to do anything. So be careful. Now notice that Vanguard, you see, it's competition, right? Fidelity went below Vanguard. We're not going to let you get away with that. They created a new class called the Admiral class. You see, the Vanguard is the first group of ships that go out to sea. So whatever. Admiral class. You used to have at least $100,000 to get into the Admiral class, but not anymore. They've lowered it to $10,000. So with the Admiral class, you wind up paying far less than the regular index fund shares. Plus, Vanguard and Fidelity have exchange-traded funds, which are the same thing. They invest in the Standard & Poor's 500 index or some other index, and they often have fees that are lower than the index funds. The Vanguard ETF that tracks the U.S. stock market, the S&P 500, we'll take a look at the other ones, the Wilshire 5000 it used to be called, but now it's called the Dow Jones U.S. Total Stock Market. I forget. We'll get to those in Chapter 5. They have expense ratios of 0.05%. Yeah. So index funds should almost always be cheaper than their actively managed counterparts, but be careful because sometimes the brokers will try to sneak in high-end fee index funds. Slide 35 is, as I promised, that schedule for the sales charge reductions. You go back to, this is Franklin's. I'm sorry, I thought I was going to show you AB's, but Franklin's is a little bit better. For the first $50,000, they charge you 5.75%. But once you put in 50 or 100,000, it goes to 4.5%. Once you hit 100, 3.5. 250, 2.5. 500, 2, until finally, once you put in $1 million, then you pay no sales charge. So now, what do you think they're saying? Brokerage firms want people with a lot of money, and that's why they look at me funny when I say that, most of my clients are putting $50 a month away, $100 a month away, and I'm really excited about that. And they just look at me like I have three eyes in the middle of my forehead, and they say, well, you're not going to make much money. I say, I know, but these are the people who need the help, And I'm very lucky that way because I have the, broker, I have the teaching, and I have the brokerage. So I'm doing fine. Thank you very much. I don't need to go out and find high net worth individuals so I can buy a BMW or a Mercedes-Benz. Yeah. Anyway, let's read this because this is what you're up against, folks. Class A shares qualify for a sales reduction if you invest a larger amount or if your investment grows. Some brokers, not all, but some, fail to inform their clients of this feature. Instead, as the client approaches the breakpoint, the broker would advise them to start a different fund in a different mutual fund company. Why would they do this? Well, again, because they can. They're going to get a higher commission. They're trying to protect that highest commission. Now, if you do this and you get caught, you deserve to be drummed out of the industry. You can whether you get caught or not. It is not in the best interest of your clients. It's in your best interest, and that is patently wrong. And now, if you do this, and you get caught, you can get kicked out of the industry and fined and all that bad stuff that happens to bad people. So just be careful. You're not going, if you find anybody halfway decently ethical, you're not going to have somebody pull this stunt on you. And then I promised you I was going to show you the contingent deferred sales charge. Indeed, here it is, folks. This is the AB, right? This is the Alliance Large Cap Growth Fund. The first year on the Class B shares, they'll charge you 4% if you take the money out. The second year, 3%. Third year, 2%. Fourth year, 1%. So in the fifth year, after 4 years, you will not be charged that back end fee. Remember, you're paying higher annual operating expenses, so don't forget that part. But yes, you are not being charged that back end fee after 4 years. Now, a side note, annuities from life insurance companies usually have this same type of what they call the surrender charge schedule. How often? They often start at 10 or 20 or 25%. And yeah, annuities, we'll skewer annuities later on, folks. Okay. Oh, you're exhausted. I know. You're going to have to listen to this again, aren't you? Right, exactly. I know it's a little tricky. We've done our best to confuse you, and probably we're successful, so goody for us. Bad for you, bad for the investors, but goody for us. Now that you know everything you need to know, actually, we didn't even get to talking about the R shares, but don't worry about them. Now, I'm going to give you $10,000 10 years ago. And which one would you choose? Knowing that the Class A shares are typically the best, but the Class A shares weren't around for the Legg Mason Value Trust, which would you choose? Would you choose the AB Large Cap Growth Fund, Class A shares, the Franklin Growth Opportunities Fund, the Class A shares, the Legg Mason Value Trust, Class C shares, formerly primary class, or the Index 500 Abstemious Fund? Okay, now if you printed this out, it's going to be difficult, right? You're going to have to look at it on the screen because that little blue box is in the way. But it turns out that, fees are important. But they certainly do not tell you the whole story. When comparing mutual funds, you must look at many attributes, not the least of which are the rates of return, preferably over longer periods of time. And folks, I don't even like 10 years. I like 30, 40, 50 years. And they're out there, folks. They're out there. And so let's take a look at how we did. It turns out that the AB Large Cap Growth Fund, even with a dumb name like AB, has done pretty darn well for its investors. 10.27% after paying the maximum sales charge. They actually did 10.74% if you had put in over $1 million and gotten the net asset value. So that's $26,581. Pretty darn good, folks. The Franklin Growth Opportunities Fund was no slouch at 8.13%, returning $21,851. But the Legg Mason Value Trust just stunk up the joint, folks. 2.38%, returning $12,652. You would have done a whole lot better just investing in the Index 500 and getting 7.62%. $20,850. Now, how come the Index 500 didn't match the Standard & Poor's 500 of 7.75%? Well, it's easy. No index fund is going to match the index because they have those fees. However small they are, they still have fees. You can't invest in an index directly. But notice that these two actively managed funds, especially the AB Large Growth Fund, did better than the S&P 500. And that's what you're going to find. There are actively managed funds that do better over significant periods of time than the indices. So don't let people tell you differently. The big drumbeat now is that, oh, no actively managed fund can beat the index. It's just not true. It reminds me of the bumblebees. For decades, the aeronautical engineers looked at a bumblebee and said, that thing shouldn't be able to fly. It's a good thing nobody told the bumblebee, isn't it? Yeah. And so the takeaway is that with an actively managed fund, you may do better you'll probably do about the same as the index. You may do a whole lot worse. And why did we pick the Legg Mason Value Trust? Not to beat up on them, but to show you how difficult an industry it is. Because the Legg Mason Value Trust was famous. Their manager, Bill Miller, who just retired from the industry actually, I think he just severed all his ties with Legg Mason. But he basically left Legg Mason, which is based in Baltimore. And he just was so phenomenal for 15 years in a row. We're going to come back to him when we get to stocks. He beat the Standard & Poor's 500. Just unbelievable. Nobody's going to come close. Maybe somebody will come close. And if you would have done this 10 years ago, that number would have been $37,000, $38,000. And then he just got clobbered in the 2008 Great Recession. Right, so it's a tough business. Yeah, you see what you're up against? So, the news, for the most part, is pretty good, with every once in a while a little stinker in there. And people would ask me 10 years ago, why don't you invest with Bill Miller? And I would say, not that I didn't respect him, certainly I respected him, but he was too concentrated. He would keep about 40 stocks and make very large bets, which is not the reason why you buy a mutual fund company. You buy a mutual fund company for professional money management, but also for diversification. And it works great when your companies are doing really, really well, as they did for 15 years in a row for Mr. Bill Miller. But then it's a two-edged sword. You live by the sword, you die by the sword when your particular investments go down the porcelain oasis. Yeah. Okay, so checking for comprehension. We're almost done. Stick with us. We're almost done. Slide 38. These shares do not have an upfront sales charge. No. Instead, they assess a decreasing back-end load if you withdraw your money within 4, 5, 6 years. The annual operating expense is higher courtesy of the 12B1 fees. Are they A shares, B shares, C shares, or F or I? If you've already printed it out, you know that they are the B shares. Back-end load, B shares, contingent deferred sales charge. They normally revert to A shares after 6, 8 years or so, and get the lower annual operating expenses after that. Slide 39. These shares do not have an upfront fee, and only a 1% back-end fee if you redeem the shares within 1 year. The advisor calls them no load, but you notice that their annual operating expense is higher than the other share classes, again, courtesy of those ubiquitous 12B1 share fees. 12B1 fees. A, B, C, or the FI shares? Right, they're the C shares. And they'll sometimes revert to the A or the F shares after 10 years or so. And so after that, you get the lower annual operating expenses. And then slide number 40. Your financial advisor tells you that these shares have no sales fee, very low annual operating expense. She mumbles something about the wealth management. These are the A, B, C, or FRI. Right, these are the FRI shares. She also did her best not to explain to you that her brokerage firm will charge you an extra 2% each year, but they'll send you a bottle of wine on your birthday and take you to the golf course, and so everybody will be happy. You're going to go over this again, right? I know. It's confusing, and partly that's the reason why it's confusing, so you won't understand it, but you're going to understand it, and remember, you're going to be the expert. You are already the expert for your family and friends. You already know 200% more than they do after going through chapters 1 and 4, and so you've got to know this down. And also, I'm going to ask you on the test. In our next presentation, we will try to wrap our arms around the industry and take a look at just the major classifications of mutual funds. Okay? Study hard, bring honor and glory to Southwestern Community College. We wish you the best of success, all those other things. See you in our next presentation.